the 15th of January 2010, and we've got some market weakness here today. So let's go ahead and just take a look at the S&P 500. Right now we've got, okay, so here we are. We've got the S&P 500 down right at the 20-day moving average, and also kind of right on this trend line that's been in play recently. Actually, if you back it up to a daily time frame, you can see that that trend line is more prominent than what that intraday time frame would tell you as well, as the July lows, after, of course, remember that inverted head and shoulders pattern a lot of people thought would be the top from that failed move, and these lows came this fast move and the subsequent strength since then. So this uptrend line continues to be important, as well as just some prior resistance right in this area from the last week of last year. So let's take a look at that on a 30-minute time frame. You can see here that this level here, the 113.20-ish area, or basically about 113 to 113.20, is the basis of what I was outlining in this morning's video, is chart of the S&P 500 on alpha trends, which is that a lot of times you see that the market comes up to a level, and it's easy to imagine these patterns, and here you can see a lot of people calling this maybe, or maybe not yet, but calling for a double top here. Just because a market finds resistance in one particular area twice does not mean it's a market, a double top. I mean, you could have called this a double top back here, but for it to really engage, what you have is point A, you've got point B down here that forms the basically the bottom of the or the midpoint of the M, and then you have C. In order for this double top to play out, you needed to break that, so you needed to break below this support in here. And this support also happens to be a much more important level when you look at it on a bigger time frame. That 113 to 120.80 is a big level. It's where we have this trend line. It's where we've got this 20-day moving average. So what the correct way to interpret that right now is we have the potential for this double topping pattern on an intraday time frame, a 30-minute time frame, and as we're at this level where we're encountering some supply, that we want to be aware that we got the market to come down to that midpoint that forms the M, and we've got now what we're getting right now at the moment is a bounce from that level. We've got a declining 5-day moving average, so that puts us on defensive, as well as just the fact that we've come so far so fast, and we're starting to see that some of these markets are in fact losing ground for the year. Right now, the as it stands, the S&P is just about up 2%. The semiconductors, though, which we'll take a look at in a minute, are down 3% year to date. Oil's down 2%, and the Nasdaq is just barely, less than a third of a percentage to the positive side. So the S&P 500 does give us reason to look. I mean, you look at the magnitude of this rally, and then even back it up even further down to the March lows, and then you're looking at let's see, let's get some more data on there. I guess I don't have enough data. Anyways, let me just make that up to 300 days so we can get a better look at it. But here we can see, we'll start looking at these trend lines as well, which come into play. So this is at a critical level for a few reasons. And then when it's at a critical level, what it means is longer-term investors should probably be lightening up or have one foot out the door in some of those positions where they have accumulated large positions. The short side has really only made sense from an intraday standpoint for several months now, really. Here we can see on this 10-minute time frame, this is that this is that level where we were supposed to find support, and the sellers did slow down their activities in this area, and buyers started to sneak some bids in there, but the market remains fragile, because if we just see that what we're forming right now is a lower high, then we can break through this 113 level. That smashes through the 20-day moving average and the longer-term trend line. It doesn't mean the uptrend is done. It just means the uptrend has lost some momentum. But it would put into play a realistic chance of coming down towards the rising 50-day moving average, which is now found near 111, and that that would be a healthy pullback realistically. I mean, that only gets us down in the S&P right to last year's close. So it seems like a long distance away, being that it is basically, was that 2.5 points or so, 111.30. So about 2.5 points or so. But still, it's it's worth avoiding if you can, obviously, as a trader, and protecting some profits if you're longer term. Will the 50-day moving average hold? That's anyone's guess. But again, it's the direction of the 50-day moving average that matters most. We're going to get some shakeouts below it, as we've seen, but those shakeouts are considered innocent till proven guilty until we have that 50-day moving average crossover and then begin to show signs of moving sideways. When and if that happens, and eventually it will, then we want to be looking at longer term time frames and saying, where do we have a reasonable chance of pulling back? Right now, that's not, that's too anticipatory because too many things have to happen for a break of 111. That's, these bigger levels are really that 112.80 to 113, and then down at the 50-day moving average. And of course, that's a moving average, so it won't be in the same spot on Monday as it is today, or Tuesday or Wednesday of next week. It's a it moves basically. So when we look at the S&P 500 again, it means that we need to be cautious. Here's something I wanted to show you as well. I look at this advanced decline line, and today, right from the start, I mean, it was immediately just deteriorating very quickly. The number of decliners was massively skewed to the downside, and has stayed that way all day. We're close to the best levels since the initial move here in terms of advancers, and we're getting a slight rally in the S&P 500, but only up to the daily VWAP, and the daily VWAP is declining. So if you've been playing, I saw some people talking about this rally unfolding in the SPY. If you have some little profits from a day trade, here's a place where you want to be very careful and protect those profits, because this will often act as resistance. Especially when it's declining, and we have a larger damage done on longer time frames. And in longer time frames, we're only talking about the last week or so here. For the week, the S&P is down slightly, as are basically all the markets, but no real damage done. We're only looking at reason for caution in the SPY. Same thing goes true for the Nasdaq 100, the NDX, or the Qs. So basically, it's the NDX traded vehicle. But here we're in a range. We're range bound, but the primary trend is higher, so it remains innocent till proven guilty. If we take a look at the 20-day moving average in here as well, and breaking a moving average doesn't mean the market will fall apart. It means that there's buyers in there. What is the relevant level of support, though? Well, if we take a look at a recent trend line, we're basically right upon that level, and that this area in here near 45.50 takes on further significance, because that's been tested basically in this area twice. So we have a slightly lower high, but only on, we're looking at a 90-minute time frame here, and that lower high is occurring over the course of just this week. So you can't get too concerned about it. Yet you want to be aware, but not really concerned. What would get me a little bit more pessimistic in the near term would be a move below 45.60. That's basically also where this market closed last year. So we're bouncing, we're maintaining positive. Looks like we're going to close positive for the third Friday of this year, or actually it's the second trading Friday. We'll close on the first, but third Friday from an options expiration calendar standpoint. But if we break that, then we're going to be focused on the 44.50, which was the basis of this ascending triangle that we had noted back in mid-December. So taking a look at the Russell 2000, we've got the Russell in broken this trend line last week, but now we're pretty much kind of range bound between 63 bucks a share and 65. Breaking the 63 would give us reason to become more cautious, and then we would look for the low, the December 31st low to be tested, and that's basically right around also the same area, that 62.50, as prior resistance from September or October of last year. That's this level in here. And let's take a look at this too, because this is interesting, because even when you recognize these double tops, okay, so what is a double top? The market rallies, it pulls back, forms a low, rallies up to approximately the same area as point A, so here's point B, and then what happens is that it makes another high in about the same area as point A. Well, then it breaks a trend line, and then it breaks below point B. Now, in theory, the textbooks will tell you that what's supposed to happen is when it breaks below that level, what we do is then we take the height of this pattern, that is, once it breaks below point B, that what we want to do is we want to take the height of that pattern and subtract it from the point where it breaks, and that gives us a downward objective. In this case, it meant, the textbook said we should have gone down to 53 and a half or so. In reality, what happened was pretty much the same thing that happened in reality with the SPY when everyone recognized that head and shoulders pattern back in here. That just because it breaks, these patterns, a lot of technical analysis patterns simply fail. Because too many people are watching, the opposite crowd will take the opposite side. They're good to notice, they're good to be aware of, but they're not a reason to just enter an order and say, okay, now I'm expecting it to go down towards this 53 level, so I'll put my buy order in and forget about this, set it and forget it. That's not the way it works in the market. It might work good for a rotisserie chicken, but not with stocks. You have to manage risk always. That's always job number one. You want to be aware of these patterns and then say, okay, now realistically on the S&P 500, after a drop with this magnitude today, do we really expect it to break down? No, you expect a little bit of a bounce, but if it makes a lower high, then it breaks down, well then you manage risk and you set your stops below the lower highs. You don't wait for it to hit this 111.20 or whatever number it is. That's the way you would look at it in a theoretical way, but in live trading and when you've got your money on the line, it doesn't always work out the way it's supposed to in a textbook about technical analysis. So that's why it's always risk management that's job number one. The biggest area for concern about this market right now, in my mind, is the semiconductors, because these guys led this market higher, and now they're declining. We had seen yesterday that they got right up to this prior level of support and that declining 5-day moving average. That's the red line in there. We'll take a look at that just on the 30-minute time frame. You can see, so here's that 5-day moving average on the 30-minute time frame. Going back to the 90-minute, just for bigger perspective, though, what we see here is that we've had this resistance up at 28.80 or so. Then we had support tested down at 27.90, 27.85, and today we're seeing a lower low. So now we have a series of, we have this lower high, and now we have these lower lows as well. So the market broke below this prior resistance from late December. That resistance had active support on the prior bounce, and now what we would expect is a test of down near this level, 2650, and you can see 2650 actually is a bigger important level on a longer time frame. So if we back that out to the daily time frame, you can see that this 2750 area, basically right in here, we have that prior resistance, which was support here for about 3 weeks, and now it's also the approximate location of the rising 50-day moving average. So it doesn't mean buy at the 50-day moving average. It means when it gets down, if it gets down to that 50-day moving average, what we want to do is we want to look at these shorter term time frames and look for evidence that maybe the buyers are emerging and that it's starting to show some support in there. Otherwise, it's just an interesting level. Maybe and it's where People who are short will begin to cover their short positions and lock in some profits. It's also where we'll see the early buyers come in and nibble. So we'll have less demand most likely, or less supply rather, and more demand coming together to kind of create that self-fulfilling level of support in there. Financials have broken that 1510 level once again, so this market's kind of acting a little bit more range-bound than anything. But you see that we're also right near this prior resistance. Let me just take that off there though. The important thing is we held above the lows for the week near 1490. We did so today with JP Morgan reporting earnings, and we also did so with news of this financial tax from Washington. So you look at JP Morgan. JP Morgan gaps slightly lower here today. JP Morgan is looking more neutral than anything. I mean, it looks very similar, obviously, to the financials. But looking at the financials on a daily time frame, we're still realistically within this 1580, 1550 to 1380, which we're in that range. It's still constructive within that range. But today is a little bit heavier volume sell-off. The heavier volume seems to be coming on the days when this market sells off, so that's definitely something to be aware of. But for now, 1490 is a fairly important level that should continue to act as support for this market. Breaking below that, then we'll probably be looking at a test of that 50-day moving average down near 1460, and then we'll have to assess how it responds to any such test, basically. That's going to do it for the market kind of summary of where we're at here right now. I do have a pretty good sized list of questions from people who've tweeted them in.